Now let's get more on the latest developments from a man with more than 15 years investment experience. Luke Spajic is Pimco's European Head of Credit Portfolio Management, and he joins me now. Luke, thank you so much for joining us. In terms of what we're seeing, it just seems that actually every day there's a new Euro era record on a lot of these yields. The 10-year Irish just touched such a record, Portuguese bonds as well. Are you concerned that no matter how much money we're pouring, it seems that the situation is not being handled?
Well, good morning, Francine. Yes, the market levels are a bit concerning, but I think what investors want is certainty. They don't want information. And I think we're at a point right now where we need to see a positive outcome from the Greek vote on Wednesday and on Thursday. And we need to see the Euro finance ministers at the weekend hash out precisely what they want to do in terms of any kind of voluntary rollovers with their local banking systems. And once you have this information, you need more certainty.
And actually, Luke, is this really crucial? Because we are expecting to have more news on the rollover. Do you believe that what we know so far, for example, the French bank saying that 70% will actually roll over their debt, as things stand, do you believe that the credit rating agencies will class it as a default or not?
Well, that depends on one simple thing. If these securities come to maturity, and a decision gets made to roll them, then it's unlikely to be an event of default. However, if these securities are rolled before maturity, then it's likely that rating agencies will act upon this and will most likely put it into selected default.
And what if, we talk about, for example, forcing some of these banks to have higher interest rates so that it would seem more voluntary? Would this make it a non-default scenario? No,
the rate is not relevant. It's whether there is any kind of change in the terms of the contractual agreement of the bonds, the maturity of the bonds.
So is there a danger, though, still that actually the existing debt will be subordinated?
Well, there is a danger, partly because over the next 2 days, well, especially tomorrow, Wednesday and Thursday, are going to be crucial, because if the outcome of the elections is negative, or if there's any kind of pushback from the local political process, then we go into a very, very murky position. With regard to seniority, I think it's interesting that we know where the IMF stands in all of this. We know where their level of seniority is. We kind of know where the ECB is, and they're not going to roll, and they are just like every other unsecured creditor, and the banks will be just a part of this unsecured process as well.
I'm trying to get your sense, Luke. I mean, I know there was a danger that actually debt will be subordinated, whether as things stands, and again, I know it's very difficult because we don't actually have all of the details, whether you think the markets are too bearish about what they're saying, that we will at the end of the day see some good news out of what the EU decides, or whether you're very prudent, and actually we really don't know what they're going to come up with by next Monday.
Right. We're at a very, very sensitive point. What we do know is that over the short term, the IMF and the European Union have made a significant commitment to Greece, and that Greece needs to make that commitment back on Wednesday and Thursday and go through the medium-term program and figure out exactly what they want to do. It's the commitment that we're trying to assess, and the market has every reason to be concerned very, very short term about what could happen. And very, very long term, we are much more concerned about the debt dynamics of Greece. So what's critical here is how this orderly process gets managed. If it becomes more disorderly and investors start to be concerned about Greece, it's not just Greece they're going to be concerned about. They're going to move towards Ireland, Portugal and Spain, and then whatever levels you see right now become almost irrelevant, because the markets will move to a position where they don't think anyone's in control.
Yeah, it was interesting actually listening to the Irish finance minister saying, well, at least there's not Spain. Is there a real danger that this is going to spread to Spain? And if it spreads to Spain, what actually happens?
Right, well, to be honest, it has kind of spread to the other markets as well. Spain is trading a lot wider than it was, and obviously investors know what Spain needs to do. They have to resolve their banking system. They have a very important IPO coming up in Bankia, and they need to recapitalize their bank. So they have their own issues to deal with, and then the biggest concern that investors have is whether Spain loses access to markets because something disorderly happens in Greece. And at the moment, if the policymakers can keep a handle on what's going on both in Greece and in other parts of Europe, then we shouldn't really see a disorderly outcome in the very, very short term, and that should keep the markets open for places like Spain.
But what are the chances that actually Greece will have to default and therefore the unknown comes afterwards? Are we talking 60% chance? Is it less at the moment?
I mean, the probabilities are massive, because if you look at the implied defaults, whether it's in the derivative market or the cash bond market, they're telling you that these securities are trading at, at 40 cents on the dollar, some of them. That's a significant write-down already. It's telling you the markets are exceptionally aggressive with regard to what they think is going to happen to Greece. It's not a 50-50 situation. It's much, much worse than that.
But in the next couple of months, or are we going to have to wait to 2012 or 2013 to talk about default? That's what I'm trying to understand. Are they going to get the 12 billion in tranche that they need in July?
Well, let's classify it in just three ways. You have a reprofiling in some kind of voluntary rollover. Then you have a potential restructuring, and then you have a default. Now, there are different ways in which interest payments can be stopped. For me to call a default on Greece instantaneously over the next 3 to 6 months is just very difficult to do. But what is really obvious that as things stand right now, Greece cannot really grow into its debt structure. So things are going to change, and whether that's orderly or disorderly is going to be the key. And we're banking on it being an orderly process at the beginning, and then we have to wait and see when more information comes.
What happens if we do get a default or even a major credit event? Some people have likened this to Lehman Brothers, and yet here we've had time to prepare for each other. We have time to prepare, and the banks have prepared, or so we'd hope.
Right. Well, I think the couple of points there. First of all, I think when Lehman defaulted, this was almost a heart attack for the global financial system. I mean, the payment system stopped. Banks weren't prepared to talk to one another as counterparties, and that bankruptcy really it opened up a lot of other risks. In other words, it opened up all the fragilities around the global financial system, and it brought to an end a massive credit bull market. I think if Greece were to default, I think what would actually happen is then investors would turn their guns on sovereigns. It'd be much more aggressive with regard to figuring out what is interest rate risk and what is credit risk with regard to sovereigns, and it would impact banking systems. It may not be as brutal as Lehman because it wouldn't be as instantaneous, but it could be quite deep and it could be quite prolonged.
Look, I just also want to show our viewers some live pictures there from the main square in Athens. This is the fourth 24-hour strike that we've had in a year in the country and also in the capital. Are you concerned that by looking at scenes like this is what is going to be the future of Europe? That a lot of the other countries also not only won't be able to push those austerity programs through, but the politicians will have to fall and coalitions be reformed, very wobbly coalitions.
Yeah, and I think we're talking about democratic countries, and I think people have a right to voice their concerns. But at the same time, there are bills to be paid, and there are debts that have been collected over time that need to be repaid. And I think that the whole domestic political process, whether it's in Greece or in Spain or even the UK, you are going to see a much deeper dialogue, much more concern about austerity and about distribution, the distribution of income, the distribution of taxes, and how taxes get raised. And I have a lot of sympathy for people that protest when they see a political process that isn't really working very well. But at the same time, once in a while, electors get a chance to go to the polls and figure out who they want to stand by.
Look, let's say that actually Mr. Papandreou manages to rally the troops even by a thin majority and pushes through these austerity measures. How disastrous would it be if on Monday we wake up and we realize that the rollovers aren't voluntary? Are we going to see a big crash in the market, and what does it mean for your investment in bonds? It's
certainly going to be unexpected. It's a crash, a very strong word. I think risk aversion in many forms has been seen over the last 2 or 3 months, and people are, if you look at the credit markets right now, it's pretty sensitive, and I don't think that's really the central scenario that people think in terms of what the banks are going to be doing next.
Look, we're almost out of time, but in 30 seconds, tell me, would you be buying any European bonds at all, or do they just seem does everything seem too tricky?
Well, I'll make a case for my own markets. I think investment grade credit markets around the world look reasonably attractive. The kind of implied default rates that we're seeing right now are 8, 9, 10, 11%. For investment grade, they're never really realized. So I think the risk premium is pretty attractive.
All right, Luke, a pleasure to speak to you. Thank you so much for all of that insight. Luke Spajic there from Pimco.